Vikash Kumar Jain, CLSA investment analyst, joins us. Let's connect with him and let's talk markets and let's really talk about the general mood point in terms of the market in the mid-cap space. Vikas? All right.
Hi.
Good morning. Can you hear me?
Yes, I can. Loud and clear.
Your frame was shaking. No wonder markets are also shaking. So the spirit is everything is shaking. How much more the shake will continue?
Well, I'm quite surprised with how long it has lasted. Maybe it's a little bit to do with the season. January and February are typically the worst months for Indian markets. To give you a sense, one might argue that fundamentally there isn't so much room for an upside, but I also look at other elements to it. Like, for example, sentiment is one thing that we do try and track quite closely. We have our own proprietary India Bull Bear Index, and that is printing numbers which are the lowest we have seen since COVID. In fact, if I were to, say that COVID was an exception, so if I ignore that, the current sentiment is as low as it was, say, around demonetization or around the time when India, post the taper tantrum around 2013, when India was seen as one of the fragile five economies. So, in terms of market sentiment, it's pretty weak. So it's something which has historically always led to some kind of a pullback. And I would suspect that there could be one coming. I do not know, and the tough part will be, is this something which is going to be powerful enough to take to new highs? I think that's a more difficult call to take. However, from our perspective, the way we look at things, a short-term rally is something which should be our base case right now, where sentiment has gone down.
Sentiment is one-sided, and you've talked about levels that it is as bearish as what we saw at levels of demonetization. But valuations are perhaps not as attractive as what they were when demonetization had happened. So can the markets rally if sentiment is bad but valuations are expensive?
So our sentiment benchmark, that's why it takes into account not just, it's a proprietary benchmark. We don't really give out the details of what goes inside it, but it does take into account fundamental indicators as well as the other indicators which form a sentiment. So it's a more comprehensive benchmark, and that has allowed us to, at times, not really pay a low, as much attention as, valuation being the only driver. So I would say that this is something which has happened before as well. There could be a rally, but the extent of the rally is something where valuation comes into the picture automatically. Because if from where we are right now, it is going to be tough to imagine that going to be a 20-30% rally. However, can there be a very quick 5-7-8% rally which allows sentiment to go to neutral or to bullish a little bit, and then we could have another correction? Absolutely. That's something which, in fact, if you were to gun to my head, if I have to choose one, I would say maybe a rally, but not really going to all-time highs, and then maybe more range-bound or corrective action.
So assuming that there is a rally around the corner, 5 to 7%, it could be 8 to 10% in mid and small cap stocks. Should one use the rally to clean up?
I do not know about that mid and small cap stocks. I think we're used to seeing mid and small cap stocks outperform in every rally. Yes, in Durham there might be, but what I do here when I talk to a lot of fund managers is a lot of them are feeling a bit stuck on mid and small cap stocks because suddenly on bad days, liquidity isn't that much and it's not so easy to get out of them. I clearly am a proponent of large cap stocks. In fact, in this correction, your certain large cap stocks have become quite attractive from valuation perspective as well. I think my sense of what has happened is, if you look at the setup, there's been a general movement towards US away from EMs, but within EMs, so far, whatever's come out against China hasn't been that bad as it was initially thought about. So within EM, there is a move in favor of China, and that's why the Chinese market, which started from Jan of last year, Jan of 24, has continued to outperform significantly as compared to Indian markets. And I think in that move, people have just sold whatever they could have, and there's been a lot of selling in large caps. I think mid caps, given where valuations are, would be clearly, I think what will happen incrementally is people will be, for every rally, will try to get out of mid and small caps and position even within their India weight position more in the large caps, because large caps have definitely, some of them have become reasonably attractive.
Right, very good morning to you, Vikash. Shahil also joining in the conversation. And you did say that a lot of large caps have become attractive. So I'm tempted to ask you then, which sectors are you finding attractive bets right now, especially in the large caps?
So I think, see, the sectors that we like is something that we run our India portfolio on. We we went at the start of the year a big overweight on staples. I was kind of seeing actions in post the central elections in 24 and the following state elections and the underspending in capex as indicative of the government will pivot towards consumption. Of course, I did not really predict that it could be that strong in terms of the rate cuts that we got in the budget. So I think consumption incrementally is where one should look at not just staples but otherwise discretionary. Although that's a space that we currently do not have, but uh, consumption in general is a place that one should look at because this is a space which has been largely ignored over the last so many years in the large cap consumption space because the focus has been far more on capex. So our call is look at things like consumption in financials, maybe incrementally look at more rate sensitive things because there could be more rate cuts too. Incrementally, if you look at RBI appears to be more focused on boosting growth, and their own estimates also suggest that we could be in a situation where growth is a little lower than what they earlier forecasted, and inflation is also lower. That gives them that headroom to do more around growth. So I would say that interest rate sensitives could be where incremental ideas could come from. The other sector that we like is commodities. Right now, it doesn't really look like commodity stocks have done so much. There's been a lot of worries around tariffs, etc. As things settle down, I think valuations over there are also looking all right. Banks is what we like, but we do not like it as much as we used to. So our overweight has come down a little bit, quite a lot, in fact. So I think I would say consumption in general, rate sensitives, and commodities is what we would like to focus on and stay away very clearly from industrials where expectations have really run ahead of themselves. They need a longer time to catch a breather.
To read between the lines, you would rather say that it's time to move away from build India sort of themes, which were based on the capex themes, growth related themes, and go to consume India based themes because you've spoken a lot about consumption. You did speak about rate interest rate sensitives as well. So, can I concur that this is what you are inclined towards now?
Yes, but also note that this is a lot of this is to do with expectations in the stocks. I mean, I'm not suggesting that in the longer term capex is gone, but their expectations rallied well ahead of themselves. They could have a longer consolidation period. And consumption is where expectations were so low because the government had done nothing directly for consumption for, that has been their philosophy. But that is what has changed. And that's where we could have incremental surprises come from. So, that's how I would look at it.
All right. Hi, Vikas. This is Shrishti also joining in. Good to be speaking with you. But help us with your take on the financials, Vikas. Because, yes, we can debate about the valuation part, but the fact is that FIIs have a significant exposure to the financial names in India and they have been selling. So, what makes you bullish and what makes you feel that financials is the place to be?
A part of that is also misunderstood. After the weight increase that the largest bank has seen in the foreign benchmark, the foreign overweight FII overweight in banks is by far the lowest it has been in any time on record. I think they would be down to something like 1 or 2% overweight only, which used to be a very high overweight number. So I think a part of that has already kind of played out. In fact, if you were to see during this period, banks have not done that badly during this last part of correction. It is not no more that over owned a space like it used to be in the last few years. And that a lot of that has also gone to the fact that the neutral weight of the benchmark itself has gone up. So I would say that, but nonetheless, within banks, incrementally, we are in a little bit of a tough setup because rates are being cut, and the more traditional, more CASA funded kind of banks may not see a favorable macro for them. However, I would say the less CASA funded kind of banks and more NBFC kind of financials could be the place where incrementally the macro looks more, much better. So within financials, it'll be less of the typical banks and more of the others is where the more adventurous part of the rally could be.
All right, and also Vikas, now that on the Nifty 50 side, we have seen all the earnings coming in from the broader market as well. We are at the flag end. Help us with your take on the earnings, because we believe and we do note that there were not high hopes from the Q3 earnings season, but we haven't seen a major disappointment for say coming in for in the results. So what's been your take on the earnings and any sector that you wish to flag off?
I think that's correct that, there's not been that bad earnings like the previous quarter, but nonetheless, earnings have got downgraded. And this is where we come in a little bit of a worry on the room that the market has in terms of to go up. If we were to look at a 7% kind of a bond yield, then the typical bull case PE for the market will be around 20x or so. We are a little lower than that. So maybe where we are somewhere around 19 to 19.5x, you don't really have re-rating room beyond 5-7%. And then you will again get to a point where things will start looking expensive. And that's where if you have earnings downgrades continuing, that room starts shrinking even more. And that's really, in general, that needs to possibly stop. But nonetheless, we had started the quarter with relatively low expectations, and from that perspective, downgrades have been more manageable. But incrementally, we need to, for us to find room to go up, we clearly need to limit earnings downgrades, and that's really what will be the key thing to watch out for.
So, because there are a lot of views which currently are now having an impact on the way how this entire FI flows is likely to move. One is dollar, second is China, third is US yields. What to your mind are the 2 or 3 data points which in a sense could act as like canary in a coal mine, which would tell which way FI flows are likely to move or they are likely to come back?
Okay, I think clearly it is around US yields and dollar, because that will determine the sentiment on EMs in general. Incrementally, if we look at unless the sentiment on EM improves, which leads to inflows into EM in general, it will be tough for India to find large inflows for now. Or sentiment on China needs to worsen significantly. But I think incrementally, it looks like if you look at the rhetoric that is coming out, unless there is something which just a 10% kind of a duty, talking of more reciprocal kind of tariffs on a lot of those things. And in the middle of all of that, if you see DeepSeek, China doesn't look like that bad a place. In fact, it looks like a relatively better place within the EMs. So I would say it has to do with general EM inflows coming in, which will only happen if Dixie kind of cools off. Without that, it'll be tough to imagine that we get a more positive opinion on Dixie. On that same breath, if you were to ask me what is the number one thing that I'm watching as a risk, that is US yields. I think currently the differential between Indian yields and US yields are at levels which basically requires Indian yields to go higher. If Indian yields go higher, then our room for re-rating reduces significantly. In fact, if you look at last calendar year, US yields, despite several rate cuts from Fed, went up by 80 bips. Indian yields, despite no rate cuts by RBI, went down by 50 bips. I think that 130 bips outperformance of or relative bigger fall in Indian yields was a bit too extra than required, and some of that might be given up. And that's really my bigger risk that I have, that given that setup, unless US yields cool off, the risk is that Indian yields might actually, despite rate cuts, could go up to 7.25, 7.5% in the worst case. So those are the worries that I have, which is going to be my biggest worry on the markets, because that shrinks the bull case PE itself at which market can sustain. So that's where yields cooling off in the US will be very, very important for us to get that room for an upside.
And Fed has already said that we are not in a hurry to cut rates. They've put cold water on all the hopes which we had, let's say, 6-8 months ago. So Vikas, let me summarize today's interaction. Point number one, short term. Markets are oversold. Rally according to your proprietary indicator is around the corner. It could be 5, 7, 8, 10%, who knows, but your proprietary indicator, when they have indicated these levels and this kind of positioning, we normally tend to see a short term rally. That's point number one. Point number two, you think it's time now to move and pivot away from capex and infra names to consumption names because valuations are stretched there, economy is slowed down, and those are still Humpty Dumpty bloated stocks. Third and more important here is that you don't expect FIs to come back in a hurry because of China and because of yields, which means net in the medium term you're bearish.
Yeah, in the medium term, absolutely. I think if we are able to scrape through this year with 0% kind of a return from where we started, that's not a bad place, honestly, because we've had a fabulous 4-year rally. I think if we can consolidate without too much give up on the absolute price, then that's not a bad place to be in. But there will be these periods, and that's why the thought process for active fund managers this time should be, they need to be a little bit more nimble this year than what they are typically used to. So I think that's where I think, and just one more thing on the sentiment part, the reason why I'm differentiating so much with the short term to medium term is this kind of sentiment reading is, we've only got it 4 or 5 times in the last nearly 18 years or so. And 2 of them are GFC and COVID. So if you take that out, only 3 or 4 times that we've been so weak on sentiment. That's why it's very tough to ignore it.
All right, point taken. Thank you so much, Vikash, for joining us on the show. Give us a view about where the Indian markets are headed, which are the pockets that you are finding attractive. It was great to have you on the show this morning. Thank you once again for being a part of the show.
Thanks for having me.
But talk.